What's up guys, Jake here. In today's video, I'm going to show you how to buy a call option on Charles Schwab's platform. In the event you haven't seen my series on how to trade options, I will include the playlist down below. I've already made a video for selling a put option and selling a covered call, but today we're going to be buying. And when you're looking to buy, call, and put options, it might be a good idea to reference the VIX. This shows the amount of volatility in the market. And right now, things have been kind of calm. So when there's a big spike, that's a bad time to buy call and puts, a good time to sell for premium contract prices. And right now, the VIX is down to 21, which is pretty low. And the stock we're going to be buying a call option on is AT&T. Now, when you look at their stock graph going back 5 years, the stock has been as high as 43. When the pandemic hit, it fell off a cliff and it went down to 27. However, it did bounce up to 32 in June, but when you look at the 6-month chart, it's a very well-rested stock, meaning it's consolidating sideways. Based on their fundamentals right now, I don't think it's going to go any lower. It's pretty depressed. However, this is a very profitable long-term company, huge conglomerates. They own all kinds of subsidiaries. I'm positive, even though they have a very high level of debt at the moment, their dividend is secure. They're a money-making machine. So once they just reorganize some things, I see this stock popping back. The problem is I don't know when that's going to happen. It's consolidated sideways around 29, and any moment it could just kind of take off. And I think it will happen in the next couple months, which is why I want to buy a call option on AT&T to capture that profit should the stock have a breakout any point in the next couple months. So this is what my Schwab brokerage account looks like. I'm currently doing a swing trading challenge, which is why it looks a little weird. I'll link the playlist down below if you want to check it out. And I actually already own or I've sold a put option on AT&T, meaning I collect the premium and I have the obligation to buy should AT&T's stock price go below 28. So it's currently at 28.95. You know, if it does go below 28 by March 19th, I'm happy buying 100 shares from somebody else for that price. I personally think AT&T is going to go up, which is why, in addition to selling a put contract, we're also going to buy a call contract. So on the right side, we can go to the drop down and we can click on option chains. Let's look at some option chains. So this is what the option chain looks like on Charles Schwab's platform. We're going to select an expiration date just for June 18th. So this is 4 months in the future. We'll click continue. For fun, well, we can stick with just 8 strike prices. We're going to select just calls because that's the only thing we're interested in buying today. And what's usually a good strategy is to choose the strike price that is closest to being in the money. So the share price is $28.98. So the closest out of the money option is $30. So what you're paying for with these premium prices is just extrinsic value, meaning time decay and implied volatility. If you start buying in the money contracts, you have to pay for the extrinsic value in addition to intrinsic value. How deep in the money are you? So think about it. If you're buying a call contract for a strike price of 30, you wouldn't exercise it right now. You wouldn't buy 100 shares of AT&T for $30 from somebody else when you can do a market order on the New York Stock Exchange today and get 100 shares for $28.98. So the price of AT&T before June 18th has to go up. It has to get above $30 for this contract to have intrinsic value, and you would exercise it. Now, what is my break-even price if I buy this contract? So the buyers are bidding currently 96 cents, and the sellers are asking for 99. AT&T is a very large company, so the spread is very narrow. So I'm probably going to request. So it said the last one went for 97. I'll probably request 97 so that I can get it filled. Now, of course, one contract equals 100 shares, so that is going to cost me $98. So in my account today, I am going to lose $97 to buy this contract. However, I have value. The contract immediately after I bought it still has that 97 cents worth of value. So my account balance will go down $97 total, but then I gain something that is worth $97 in value. So my account value today shouldn't change. Now, how does this contract lose value or gain value over the next 4 months? To do that, you can reference the Greeks. I made a video explaining the Greeks, but for fun, let's just talk about it. So theta represents time decay. Every day, how much value is this contract losing? So theta is negative, it's always negative, 0.004. So it's not even a full penny. Multiplied by 100, it'd be $1. So if I buy this contract for $97, tomorrow it's going to lose 40 cents in value just because of theta decay. Now, when we look at the delta tells us the probability of this contract expiring in the money. It's only giving AT&T a 36% chance. Now, I don't think that's true. I like that because I feel like I'm getting a good value for this premium because I think in the next 4 months, AT&T will be back above $30. Gamma is the rate of change of delta. We don't care about that. Implied volatility is how volatile has these contract prices in AT&T been. 25 is pretty low. I like that. So if AT&T's implied volatility goes up by 1%, so this is 25%. If this goes up to 26, then the option premium will increase by vega, meaning that it will go up 6.2 cents in value or $6. So I like my chances here of, at the very least, this contract experiencing some volatility in the next month and then the price shooting up. And with all option contracts, you don't have to hold them till expiration. As soon as they're positive in value, if you want to buy to close or sell to close to exit your position, you can do that. So let's go back to just looking at the option chain. And once again, for the strike price of 30, expiration date June 19th, the buyers are bidding 0.96, the sellers are asking 0.99. I'm going to go with the last agreed upon price because I want this to fill for this video. So we are going to buy a call option on AT&T for $97. So here is Schwab's all-in-one trade ticket, and we are going to enter in for a limit price 0.97 because that's what the mid is showing. The action, we are buying to open. So we're buying a call option. Once again, call, strike price 30, expiration date June 19th, and it's telling me, yeah, this is going to cost me today $97. But once again, I now own the contract, which has a value of $97. When we go to review order, it is telling us there's a 65-cent commission because this goes to the Chicago Board of Options Exchange for facilitating the contracts. It's a pretty good deal for them. So the total cost to me will be $97.65. We can go ahead and place the order. Okay guys, we're back, and I actually wasn't able to get it filled at $97. Looking at the day chart for AT&T, it is going up a little bit, and the New York Stock Exchange closes in 5 minutes, so I had to raise my ask price, or my bid price, because I'm the buyer. So I had to raise my bid price to 99 cents, which isn't a big deal. Let's see here, cost per share, 99. So how you read this, let's bring this up here. Well, no, we need the top here. Okay, so the cost per share is what I paid for it, 99 cents. The price is what the contract is currently worth, so 98 cents. So it's showing me gain loss. It's gone down a penny or $1 in value since my order was filled. So it's just telling me how much I lost on the transaction so far. So once again, how do I make money on this call contract? I need AT&T's share price ultimately to finish above $30. That's how I can exercise the contract, start making money back. However, my break-even point, because I paid $99 for this premium, is actually $30.99. So this contract, if I hold it until expiration, doesn't actually make me money or anybody money until AT&T's share price reaches $30.99. Maybe it will, maybe it won't. If we can get a spike in volatility in the market in general within the next 4 months, and the premium cost of this contract goes up by 100%, I would gladly sell to close and just exit this position. And something I want to remind you is about theta decay. Once again, if you're buying calls and buying puts, theta is not your friend. Time is not your friend. The option premium becomes less valuable if everything else is constant over time the longer you hold it, especially the last 30 days. So when you buy call and you buy put contracts, yes, you're leveraging your money. You can control the fates of 100 shares of a stock without having to buy that 100 shares of stock. But at the same time, my $99 investment in this contract, I can lose 100% of that. Now, I'm confident, so I'm willing to take that risk of losing 100% on my premium contract. So we'll see how this does the next couple months. Okay guys, if you enjoyed this video, give me a thumbs up so the algorithm knows it's good. In addition, consider subscribing to my channel if you haven't already. I talk a lot about finance and investing. And until the next video, take care.